wow, we just moved higher. And suddenly my positions went against me. And I realized that I was just not prepared for that.
Hello and welcome back to another season of Two Blokes Trading. Today we've got Dr. Brett Steenbarger joining us, a psychologist who swapped the therapy couch for the trading floor. He's coached some of the top hedge fund managers in the world and has written the go-to books on trading psychology.
I mean, what the
I developed an interest in financial markets and started trading on my own.
I believe you had a bit of a loss in your early days, and did that somewhat shape your risk control, your position sizing?
It changed my views of risk taking. If the worst thing happens, you can survive that.
Something that really resounds with me that you say is risk equals survival, not reward.
I think one of the big problems that we see with younger beginning traders is
they jump into the markets thinking they can make X amount of money, and they really don't understand the level of risk management that you need to survive in the markets, which is 100% key.
If there is anything that I did right in developing as a trader, it was I always made sure that I had a full-time income. No one picks up an instrument and says, oh, I'm going to start playing, and within a few months is hoping to make a recording that will be popular around the world. What's one thing that I did well today? How did I do it well? And how can I build on that tomorrow?
Do you think there's like one psychological trait that separates the elite traders from the average traders on a day-to-day basis?
We've done research on what makes the best traders successful. And the number one quality is...
So if you're ready to learn how to master the mindset and keep your cool in the markets, you're in the right place. Brett, thank you so much for joining us today. It's a real pleasure to have you on our podcast today.
Yeah, Jonathan, thank you very much. I appreciate the opportunity to speak with everyone.
Absolutely. It's going to be a really interesting one because I want to know a lot about your background, how you kind of came from your background as a clinical psychologist, how that moved you towards coaching and trading some of the best traders in the world. It's a really interesting story. Maybe you could tell us a bit more about it.
Sure. Initially, I was teaching full-time at a medical school. I'm a clinical psychologist teaching in the Department of Psychiatry and Behavioral Sciences in Syracuse, New York. And at the same time, during my graduate education, while I was getting my PhD, I developed an interest in financial markets and started trading on my own. So the trading and the psychology occurred in parallel.
Sure.
Then I ended up meeting an editor from one of the publishing companies that was doing a lot of work on publishing trading works, and she encouraged me to write a book. And so I wrote the book, The Psychology of Trading. So put together the psychology interest and the trading interest. To my surprise, the book became popular, and a firm in Chicago reached out and hired me full-time. They were market makers in electronic futures and the CME products. And so I ended up staying part-time as a faculty member and teaching at the med school and working full-time with traders. And I've done that ever since. So since 2003.
Right. And I suppose why trading? Is it something that you just found that you could be good at? Is it something that someone was doing around you that you said, okay, I'll give that a go? Or, it's quite, obviously you're quite busy with your own profession. Was it just a kind of a side thing for you?
Yeah. And I enjoy the challenge. I enjoy the complexity of markets and understanding markets. So I enjoy the trading aspect and understanding markets. But beyond that, my main work up to that point had been in doing counseling with medical students and residents and health professionals. So my specialization has been working with people who are professionals in high stress occupations and helping them be as effective as possible. And what interested me was that working with professional traders really was not significantly different from working with professionals in the medical fields. These are all very talented, very smart people, very ambitious, totally stressed out, dealing with risk and reward in different ways, and interested in psychology to help their performance rather than just because of personal problems.
Sure. And are you still trading to this day, or is that something that you even have time for with all the coaching that you're doing?
Yeah, you're absolutely right. So it's a real time issue. So I trade on a part-time basis and I trade stock index futures, but it is very part-time. And most of my work is with the teaching and with working with hedge funds.
Sure. And I believe you had a bit of a loss in your early days. And, did that somewhat shape your risk control, your position sizing, and your own kind of ability to understand how traders' psychology and that fear from traders?
Yes. So I went through a sizable loss in 1982. In 1982, the market made a major bottom, and I was doing very well up to that point, catching the bear market. And then we made a bottom in, I believe it was August of 82. And wow, we just moved higher. And suddenly my positions went against me. And I realized that I was just not prepared for that. So it changed my views of risk taking and led me to emphasize in my own trading, staying in the game. You have to size positions so that if the worst thing happens, like being short at the start of a major bull market, if the worst thing happens, you can survive that. So that's the first thing it taught me. The second thing it taught me is to not have all eggs in one basket.
Sure.
And so instead of putting all money in one trade, the value of diversification, having different trades, different ideas, ones that are not correlated with each other. So that if one thing doesn't work out, there are other things that can still make you money. And that led me to interest in working with portfolio managers because the very nature of their work involves that diversification.
100%. And something that really resounds with me that you say is risk equals survival, not reward. I really, really like that saying. Tell me, why do you think that's such a critical shift in how traders should think?
Yes, and there is a proportionality of risk and reward. Obviously, if we're right, and we take more risk, we can make more money. But survival in markets is the number one priority. And risk taking should be a way of staying safe, surviving while profiting. So you can think about leading a military mission. Let's say you are leading a group of troops and you are engaged in intelligence operations. You're checking out the enemy. And so you're going to take some risks. You got to go into enemy territory. But if you take too much risk, you don't survive and you never come back. The whole mission fails. So the whole emphasis is how you can do your job, but make sure you survive.
Brilliant. Yeah, it's a great saying. It really is. And I think that needs to resound with more and more traders. It's the ability to stay in the game. It's about, minimizing them risks, especially early on, like learning from your mistakes and staying in the game. And, it's absolutely key. And I think so many traders, especially at the start, potentially go in for the wrong reasons. They jump into the markets thinking they can make X amount of money, and they really don't understand the level of risk management that you need to survive in the markets, which is 100% key.
Very true. And I think if I could just jump in, Jonathan, I think one of the big problems that we see with younger beginning traders is that they feel a need to make money. Yes. Maybe they don't have another income.
Yep.
And so the trading not only has to be successful, it has to be profitable right from the start in order to make enough money. So they end up taking more risk than they should simply to try to make the money they need, and they end up blowing up.
For sure. And in the same vein, it's that step between part-time trading and then actually moving into a full-time career in trading, is that all of a sudden then you need to pay your bills. You've got a mortgage to pay. You've got electricity bills. I've spoke about this in previous podcasts, but it really is a psychological difference between kind of just retail trading and then moving into that full time where you need to make money, because all of a sudden then that pressure is different. and people start looking at targets based upon their costs and what they need to cover, as opposed to percentages when they're just trading on as a retail trader. Okay, let's try and make 5% this month. Let's try to, it becomes monetary. So you're always trying to force trades to try to get to that monetary amount, it's a big jump.
Yes. And if there is anything that I did right in developing as a trader, it was I always made sure that I had a full-time income while I was learning trading and while I was doing trading. And actually, that's how I learned to trade during morning hours, because I would trade early and then I would move to my work. And so it made for a nice balance. And to this day, my best trading is in morning hours. As I become accustomed to the New York Stock Exchange Open and how institutions get involved in tracking their behavior and so forth and so on. But if I needed to make my living solely from trading, if all the pressure of making a living was on my trading, and here I'm supporting a wife, 5 children, no, thank you. That's just...
Yeah, it's a big task, and I think for anyone to jump to look to go into that pathway is to have a decent fund amount behind you, a decent cushion that you can, that you don't need to rely on them funds to cover your costs, for sure.
Yeah. One point I've made in the past is think about any profession in a performance area. So like in sports, playing soccer, playing basketball, in performing arts, being a singer, being an instrumental music player. It always takes years with mentoring to get to the point of expertise where you can make a living from your performance.
100%.
Like no one picks up an instrument and says, oh, I'm going to start playing, and within a few months is hoping to make a recording that will be popular around the world. So there is a learning curve, and it's typically in performance fields, it's typically a long learning curve. Look how long it takes for Olympic athletes to get to the point where they can compete and win. It's lots of practice, many years, and that's what traders should expect.
100%. I couldn't agree more. And do you think there's like one psychological trait that separates the elite traders from the average traders on a day-to-day basis?
Yeah, we've actually studied that. At a few different places where I work, we've done research on what makes the best traders successful. And the number one quality is intellectual curiosity. The best traders, the best portfolio managers are really interested in ideas. They're interested in finding opportunity. They're curious, they dig, and they look for new and different sources of edge. They look for new and different types of ideas.
Right.
Okay. So for instance, I do hiring at hedge funds. So if people want to become a portfolio manager, if they want to join a hedge fund team, I'm involved in the hiring process. So I just ask them to talk to me about their trading and give me examples of trades they've placed and how they've researched those and how they manage those. If someone says to me a trade idea that really strikes me as different and unique, something I haven't heard before, that's very promising.
Awesome. And surely on the mindset side of that, you're obviously, from your background, you're looking at mindset. What specific mindset are you looking for somebody you're looking to hire?
Well, actually, if by mindset you're talking about the emotional makeup of a person, actually, I'm not just looking at mindset. I'm looking at their cognitive functioning, not just their emotional functioning.
Right.
But in terms of the emotions, I'm looking for people who are excited by ideas, excited by discovery. And even when the P&L is not doing very much or when they're not making money, they're still excited about the search for ideas and finding new ideas. I spoke with a portfolio manager just recently who is involved in commodities markets. And this manager tracks the weather forecasts from many, many, many different sources.
Commodities trader.
And knows which forecasts tend to be ahead of the others.
Right.
And so they're able to get a jump on when weather is shifting, and that's going to affect agricultural commodities, that's going to affect energy products, so forth. And so as soon as I heard what he was doing and how, that struck me as, oh, that's different, that's unique, that's special. And he was really excited and talking about all of this. It was sort of like modeling the models, you know. So that's what I look for. It's a mindset of discovery and creativity.
Awesome. I want to jump kind of back into how you work and coach a little bit later in the podcast. But for traders listening now, obviously who are struggling, you know, and they don't know if it's their strategy or it's a psychological block, you know, how do they figure that out? Do you think somebody who's just retail trader, something's not going right, maybe they just lost their edge, or they never had an edge, or they're trying to build an edge, how do people figure that out? Do you think in terms of building an edge, how much is psychological and how much is strategy?
It's almost all strategy. What happens is
I like that
people
answer.
build an edge.
Yeah.
But markets are always changing.
Yeah.
They're always changing in their trending behavior, in their cyclical behavior. They're changing in their volatility. Correlations within the market and across markets are always changing. And so a beginning trader develops an edge that works in one set of market conditions. And then suddenly we get a totally different set of market conditions and the edge doesn't work anymore.
Sure. Yeah.
And then they get frustrated, and then it affects mindset, and that can affect their trading down the road.
Brilliant. Exactly.
But the real problem is that they don't develop different edges for different types of markets.
Yep. Different conditions for sure.
Different conditions. So you really need, you know what an example would be, a sports team. You know, you develop different strategies for different types of opponents.
Yep.
You might develop different strategies for different kinds of field conditions, like in football. And so you have many, many plays that you can run. And part of expertise is knowing when you do this, when you do that, you know, adjusting to the circumstances.
Yeah, yeah. And obviously you're kind of an advocate of rapid feedback loops, I believe you call it. You know, what's the perfect 2-minute daily report card look like for you or for a trader that you want to see?
Yeah, the quickest report card that I've talked about in my books is, end of the day, what's one thing that I did well today? How did I do it well? And how can I build on that tomorrow? Right. So identify one strength, one thing you did well.
Well, and what about on the opposite side of that?
Yes. And then one thing you did not well. What's one thing you did today that you need to improve, you could have improved, you could have done better, and how would you do it better, and how are you going to do it better tomorrow? So the simplest journal, one thing to improve, one thing you did well that you want to continue and build upon, one thing you didn't do well that you want to improve, every day, you're identifying those, getting better. It's
a fantastic idea. And I think, you know, having that ability to look back and every day and see where you've done right, but also see where you've done wrong and be able to learn from that, I think that's massively going to stand to you. And people can spend so many hours with trading journals and other types of formats to try to help them in trading. But I believe something as simple as that can just have a huge difference in how your future trading is going to look from today to next week to a month's time. I think that's an awesome way to look at it for sure.
The research on goal setting in psychology tells you that setting fewer goals and working more intensively on those leads to more change than setting lots and lots of different goals, trying to change 30 things all at once. That doesn't work. So just prioritizing one thing to improve, one thing that you've done well, that I find works well. What many traders don't do is they don't focus on what they've done well. They don't learn from their successes. Mm-hmm. And so they get frustrated when they make mistakes. And so they just focus on what they did wrong. Okay, it's fine to improve what you did wrong. But ultimately, you're not going to succeed by doing fewer things wrong. You're going to succeed by building upon your strengths. Yep. I have a book that's going to be coming out early in 2026 called Positive Trading Psychology. It's applying positive psychology to the trading world. And a large part of it is about figuring out what your strengths are and how to build upon those in developing your performance as a trader.
I think we can all, adjust to that in our day-to-day lives, let alone trading as well. I think it's so important to focus on, the good things and not focus so much on the bad things. And like you say, you learn so much from the mistakes and the bad things, but at the same time, maybe we put too much emphasis on that as opposed to more emphasis on what we've done right and how we can continue to do right. So yeah, it's a very interesting way to look at it for sure. I suppose while we're on the kind of cognitive side of things, you blend therapy and quant. How can discretionary traders use market data to improve their own mindset?
Discretionary trading and quant trading have come together in the hedge fund world. And so many times traders are getting quant signals and then using their pattern recognition to figure out when to actually trade those signals,
right?
When those signals are actually playing out. So an example, actually, is very timely. That just yesterday, we had a situation in the New York Stock Exchange where many stocks gave buy signals on a couple of different technical indicators. So I track every single stock in the NYSE universe and how many are giving buy signals or sell signals or no signals from different technical systems like Bollinger Bands, that kind of thing.
Sure.
And yesterday we had way over 400 stocks giving buy signals on the same day. That's unusually high. I've kept that database for a while. Well, I look in my database, and when we've had lots of stocks making new highs, or not new highs, but lots of stocks giving buy signals all on the same day, the next 10 days return on average is quite bullish. So there tends to be momentum.
Right.
And that goes along with what's called a breadth thrust. Yep. So that tells me not that today's market necessarily is going to go up or tomorrow's market is necessarily going up, but the upward trend of equities is likely to continue over a medium term, over a swing period. Knowing that, I can then use my discretionary ability to say, when are we getting selling that can't push the market to a new low, giving me a nice entry point for the buying that's going to happen later. So I put together the discretionary with the quantitative, and they work together to give a higher confidence signal.
That's awesome. It's a really interesting way to, I'm sure most of our listeners listening in will be like, kind of blown away by what you're saying at the moment. It's so true. I mean, like if you can adapt to the data that's coming to you and you have the good, clean data, you can make so much better decisions. There's no doubt about it.
A lot of traders just have trouble collecting the data. And there are good websites that collect historical data. And so one that I use is called marketcharts.com. And you can subscribe to that site and then download data and start to create your own database. Barchart.com, also a useful set of tools.
Yeah, for sure. And I think the biggest problem that people have with data is actually trying to identify that data and into a short form. So that's something that we're working on quite a lot at the moment, is the AI side of things, and trying to get as much clean data as possible, put it all together, summarize it into a kind of a short form where people's kind of digestible, where you can get up in the morning, you can check your phone, you can check an asset class, whatever that is, and get that data in a real short form snapshot of what's going on in the markets. Because especially most retail traders just don't have time to dig deep into real data and to pull that together into something that they can actually act upon. That's the hardest thing, right?
Yes. Now I have the data in a database form. And in Excel, I can run studies, and to like the study about a large number of stocks giving buy signals on a technical indicator. That study took me less than 10 minutes to do. But it's because the data are organized. It's not because I'm so brilliant. The data are organized in a database, in a spreadsheet, and I can quickly sort through the data and do that analysis. And so there's no reason, if the data are properly organized, why even retail traders can't do that.
Sure.
The problem is that you may choose to not do that, or you might say it's too difficult for me, but your competitors are doing it. So,
the people you're trading against as well.
There's an edge there that you don't know about simply because you're not looking at those data. So I think you're absolutely right. Collecting data is important. Analyzing data is important. Using artificial intelligence to help identify patterns in data. This is really, really promising.
It really is. It's huge, and it's going across the board in all industries, and that's why I think it's exciting for us, because we can go to the markets, we can get the technicals, the fundamentals, the sentiment, all in like a click of a finger. Now we've got, and all of a sudden, then you're making decisions off information instantly, that kind of way. And the key thing is clean data. Trying to pull that clean data and getting that data in just clean data is just key, because any kind of issue with the data coming in, it can completely change the outlook of buy or sell position. So clean data is absolutely key, and training that AI to understand, to find if it's going off and maybe to 100 different endpoints, coming back with that data, it's ciphering through what's a good data and what's a bad data, and that's the key to a good AI.
Right. Now, I've mentioned in the past that even in the data that I collect, I'm looking at the data differently than many people might. So, for instance, even on a chart, let's say I'm charting the S&P 500 stock index futures. So on the x-axis of the chart is not time. Each bar represents a unit of volume.
Yep.
So every 10,000 contracts traded, it draws a bar, open, high, low, close. Next 10,000, open, high, low, close. So in busier times, you're drawing more bars, and in slow times, you're drawing fewer bars. And it turns out that when you chart the data in that fashion, cycles in the market become clearer.
Yep. Interesting.
Now, when people aren't clear about cycles in the market, they call it choppy, and they say that it can't be traded.
Yeah.
But in fact, if you can see, analyze regular cycles in the market, then those pose very nice short-term trading opportunities. So it's an example of using data collection in a creative way, in a different way, to find new and different opportunities.
The key for any trader is just trying to stack as much in our favor as possible. There is no crystal ball. There's no way for us to determine where the market's going to move at any particular time, but it's all about stacking as much in our favor as possible. Once we do that, then we've got the best opportunity to try and get consistency in the markets. It's quite simple. If you have a simple strategy and you have good data, it's about stacking the odds in your favor. If you can do that, like I said, you have a better chance. If you don't, and you're trading on a whim, it's never going to work. You need that data, you need that strategy, and you need to build that consistency. And talking about that, if we're moving into like journaling, how important do you think journaling is?
Very, very important, because that's a way that you track what you can do better and what you did well, and track that over time to see your development. Journaling is a great way of structuring goals that you set for yourself. What are you going to work on this week? What are you going to work on today? All that can be in a journal. I have traders I work with who journal out loud, and it's a speech to text, and they just talk their journal. I have others who type it out, but they review it, and they review it in the morning before the open, and it gets them focused on what they need to work on in their performance and what their goals are for that particular day.
Awesome. I mean, why not utilize the technology that's available to us? I think one of the reasons why so many people don't journal It's because it's like, oh, I have to go in and I have to type this out. It's going to take X amount of time. I have to go do something or whatever. Like I said, AI and ability to be able to talk into your phone and there's your journal done. It's so easy now. There is no excuses for people not to be doing it. And I suppose in terms of I believe you have a 3-step protocol as well when it comes to if you're going into a margin call or you what is that 3-step protocol and how does it save traders from potentially blowing up their accounts?
Well, 3 steps. If trading is not going well, 3 steps to take. The first step is to step back entirely from risk taking. That if something is not going well, either you're doing something wrong with good ideas, or perhaps your ideas aren't so good. Yeah. But the really good traders, they just pull back. They pull their risk back, they stop out, and they figure out what's going wrong. And very often they'll look at, okay, well, this was a pretty good idea. Why didn't it work out? What can I learn from this trade that went against me? So right away, they're stepping back from trading. They're taking some deep breaths. They're getting themselves focused. And then they're learning from what happened. Did they do something wrong? Was there something that their ideas weren't taking into account? And then they'll re-enter the market, and with modest size, they aren't necessarily going to take huge risk, but based on their learning from the trades that didn't go well. So the way I frame it with traders is that you will not always have a financial P&L, but you always should have a learning P&L, a positive learning P&L. And so when you lose, the 3 steps are stop trading, pull back, get yourself calm, get yourself focused, and then learn from what just happened and apply that to your next trading.
Go back in with slightly less risk on the table and build yourself back up again.
Exactly. Now, that second step of stepping back from the market, getting yourself focused, on my blog, it's called Trader Feed, TraderFeed, traderfeed.blogspot.com. I've been writing about the use of wearable devices that measure our brain waves in real time. The technology has gotten amazing. Now, when I started working at the medical school in Syracuse, we were doing work as a faculty on EEG, electroencephalogram, brainwave, and actually using it successfully to help young people with ADHD. But to measure their brain waves, there was this big helmet they had to wear with all these wires coming out. You had to have specialized equipment. It was very expensive. Now it's a band you can purchase online, very reliable, and it measures your brain waves in real time. And you can do various exercises to train your brain waves, to train yourself to be more calm and focused. And you get real-time feedback. I think this is a game changer for trading psychology, because if we have a device, if we have feedback in real time that can tell us when, even before we start going on tilt, it's telling us that we don't have our concentration. It's telling us we're not really focused. We can use that information proactively. And if we can train ourselves, this is the most important part, if we can train ourselves for greater and greater and greater focus, what we find is that the markets are clearer to us. When we're more focused, the patterns in markets become clearer to us. We have greater access to intuition.
Right. Have you seen that live working?
I'm using it myself.
Really? Yeah.
Yeah. And I do that on purpose because I would never want to talk about or advocate something I hadn't tried on my own in my own trading and so forth. It's on my blog, what I've been doing recently. And what's interesting is that if I do sort of traditional meditation work. You clear your head, empty your mind, breathe deeply, breathe slowly. It doesn't work.
Right.
Being relaxed, which is good, does not necessarily make you more focused.
Okay.
So there are different exercises we have to do to become focused and stay focused.
So a stress ball won't work.
Or we don't get the full benefit. And you can see it in the brain waves. So one of the interesting experiments that I did was I put on the unit and measured my brain waves, and I began to engage in prayer. Well, I happen to be somewhat religious.
Yeah.
And so when I'm praying, like, I don't start daydreaming or thinking about other things. Like, prayer is a very serious activity to me. And so I'm completely focused on whatever is going through my mind during that period of prayer. And for the first time during the exercise, which lasts a number of minutes, my ratings for brainwaves were 93% calm.
Oh, right.
Whoa. So what that told me was the answer to being really focused is not clearing your head. The answer is to be highly focused on the right kind of emotions.
Sure. That's really interesting.
So now I'm experimenting with different kinds of emotions, not just prayer, but other sources of emotion. And it may well be that the problem for trading is not emotion. The answer is not to get rid of emotion. The answer is to become grounded in the right emotions.
Right. And do you see this something that people will adapt, like trading floors, maybe hedge fund managers? Is this something that potentially could kind of catch on?
It could. And certainly there have been people who have expressed interest to me. And all of this is something I'm experimenting with. And so, it's nothing I'm trying to sell myself. But I think it could be a challenge because if people can learn to control their brainwaves and stay focused and learn this technology on their own, I don't know, do they really need, quote unquote, a trading coach? So we may not see many trading coaches advocating the technology. It may put them out of business. I would love to be put out of business as a trading coach. If someone can coach themselves, oh my gosh, that's, to me, that's the real goal. I'll talk to them about other things, like cyclical structures in markets. It's a new technology, and we'll see how helpful it is across a variety of people. But so far, at least in my experimentation, it's showing promise.
Interesting. And staying with the kind of coaching side of things as well. I mean, how do you build a culture in firms? Like, is that something that you kind of look after as well? Obviously, a big part of psychology and in trading and people being comfortable in their workplaces. How do you build that kind of strong culture within these hedge funds and so on?
Yeah, so all the work I do these days is in hedge funds, and these are what are called multi-strat hedge funds, multi-strategy hedge funds, and all of the risk taking occurs within teams.
Right.
So it's not just an individual trader who's trading this or that. So you have teams, and the teams consist of people who are good at different things and have different areas of experience and expertise. And so there's a lot of interaction within the teams, and the teams develop ideas together. They review performance together. Everyone's learning from everyone. And that creates a very positive emotional environment, but it also creates an enriched learning environment.
Absolutely. And I guess that removes ego in somewhat way as well, right? If you're relying on lots of people to come up with, their own bits of information from their own expertise, it then becomes a collective. Is there any situations where egos still come into play in that environment or?
Always, it's human nature, and it's a competitive field. So, there are egos, and people do get stuck in their own perspectives. But if you have a team where people are expert in different areas, then you have a situation where, like in medical school, the saying is each one teach one. The whole idea is everyone's a teacher, everyone's a learner. So if I'm trading stocks, equities in the US, and maybe something's going on in interest rate markets, and it's going on in interest rate markets because something's going on with the US dollar. And so, wait a minute, the dollar is falling and interest rates, kind of interesting. Short-term rates are staying reasonably low, but longer-term rates are rising. So we have a steepening yield curve. How might that affect real estate stocks or real estate companies, the stocks of real estate companies?
Interesting. Yep.
And so by talking with experts in currencies, experts in rates, I can develop some ideas for my trading in those stocks. And again, everyone's learning from everyone, and I'm sharing my information with them.
And like, what are your top performers within these firms? Like, is there a certain trait within these guys that are different to the guys that are kind of averaging out?
They're always growing. They're always doing new things. They're always learning. They're running a business within a business. Their team is a business within the hedge fund. You can think of the hedge fund as being their VC, the venture capitalist. They're funding this business that is a team. And just like any entrepreneur running a business, you're looking for new and different opportunities. You're looking to grow and grow your team. And so the best teams, the best portfolio managers have that entrepreneurial spirit.
Interesting. Yeah, very interesting. And you kind of touched upon it. Like, this year is obviously being a mess. We've seen, tariffs, inflation, geopolitical issues. How do you coach traders to stay focused on the process when predicting current market conditions can be impossible at some stage? There's correlations are disappearing, and it's a tough time to trade at the moment.
Yes, and one of the reasons it's become a tough time to trade is because we have a lot of headline risk.
Yep, exactly.
And there'll be a headline, a political headline, economic headline, and that can move the market. And so risk taking has to be much more nimble, and you can't just put all of your eggs in one basket.
Yeah.
So trading has to be a lot more flexible. I find even the portfolio managers at hedge funds are being shorter term in their trading recently because of all the news events going on.
And
go ahead.
So in terms of that then, and reviewing performance, where maybe that performance was on a slightly longer term, now we're looking at shorter term, does that change a lot of other things as well in terms of how to review them performance levels? And, like you said, lots of things are changing. We've got people who are, we've got big investors that are looking for different returns, prop guys are getting squeezed and so on. Like, how are you reviewing performances?
Yeah. So at hedge funds, you look at three things. The first, obviously, is absolute P&L. The second would be risk-adjusted returns.
Yep.
So that would be measured by a Sharpe ratio, for instance. So how much are you making on your winning trades versus how much are you losing on your losing trades? And so you may be 50-50 win-lose, but you're making more from your winning trades. So they look at risk-adjusted returns, and then they look at correlation of returns.
Right.
So are you doing something unique in your trading? Are your returns different than just the returns in the S&P or returns from traders overall? And so the people who are investing in the hedge funds, and those tend to be institutional investors for the larger hedge funds, they know to look for all three of those things. So the absolute profit number may not be huge, but if the risk-adjusted nature of the return is good, and if it's a unique return, they're going to be happier.
Absolutely. And look, most traders, we all kind of have a bias before we go and execute a trade in the market. And I think you have to be more nimble with your bias now than ever before, because like you said, headline reaction is just huge at the moment. So 1 minute, you're bullish dollar, and all of a sudden you're bearish dollar. Do you know, that kind of way? It's, especially at the moment, we've seen dollar go through a bit of a tough patch at the moment, but like I said, it's hard to have a continued negative bias based upon something that can react tomorrow with a headline.
Absolutely. And so you always need to know in advance what would tell me I'm wrong. You don't
Yep.
first
Yep.
rehearse how much you can make. You rehearse what would tell me I'm wrong. Where would I get out?
Sure. And do you have like a mechanism to kind of recalibrate traders that have had a bad spell?
A more extended review process. If you've had a bad spell, chances are you're getting the market wrong. And let's take a look at what's working in the market. Let's take a look at what you've been doing. And so there's a more extended review. And often I'll do that review with the person, and we'll have some takeaways, learning lessons that they then can apply when they get back into the market with some relatively small risk.
And are the best traders the adaptable traders, would you say?
Have to be.
Yeah.
Yeah. The market is, think about what the market was like during the COVID period. Oh my gosh. Yeah. And the volatility. That's so different than what you have under quiet conditions. If growth is good and, not anything major is going on geopolitically. So yes, the really good traders are very adaptable.
Awesome, for sure. And finally, what's the most underrated mental habit for building long-term trading resilience? Because I think resilience in trading is key.
Building trading resilience, the habit that works best for that is to be able to find opportunity in loss. In other words, if I had a very well-researched idea, I really did my homework, and I lost money on the trade, something unique is going on that I need to investigate. If I make money from that idea, it tells me that idea is valid, and maybe there's a way of ramping up my risk. So the resilience comes from being able to learn in real time from what's going on and then recalibrate your risk taking. Maybe you're meant to take more risk, like things are lining up, they're working, go for it. Maybe you got things wrong and you need to pull back and figure out something new. It's that recalibrating process that's so important.
Interesting. Well, look, this has been a fantastic interview. I really believe our listeners will learn a hell of a lot from this interview. It's been a real pleasure, and you're an absolute gentleman. Thank you so much for coming on today, Brett. It really has been a pleasure.
Well, thank you for having me. I appreciate it, and look forward to getting together in the future.
100%. Next time you're in Ireland, we're gonna grab a Guinness.
All right. Some good places in Dublin, let me tell you. Of course, I don't need to tell you you're there. Very good.
Thanks again. Take care.
Bye-bye.
Bye now.